Welcome to the Overbook Asset Management Market Review.
Good morning, everyone. I am Nick. So let's start off first. I'm going to be referring quite a lot to MRB research. They seem to be the champions at the moment, getting the call right on inflation, so far at least. And then we're going to be also referencing capital economics and cross-border capital. The outlook for the Fed, these are views from MRB. The Fed, according to MRB, will likely have to hike the Fed funds rate by additional 50 basis points, and then to keep the policy at that rate until the end of the year. They have a strongly out of consensus view, and that is that the Fed will have to eventually hike rates further to achieve the 2% goal. Their thesis is that the neutral interest rate, that is the rate that neither stimulates growth nor restricts it, is in fact a lot higher than many believe. And so they have this to say: the US economy is inherently less interest rate sensitive than many had expected this cycle, which is why the economy has been so resilient to the meaningful rise in the Fed funds rate to date. We believe that the economy will avoid a recession even as the policy rate climbs further to 5 to 5.25. The Fed's next pivot will be in a hawkish direction as opposed to dovish, and this is a strongly out of consensus view. Yeah, it's quite worrying, I suppose. The good news, the silver lining to all of that, is that economic growth and earnings growth will be a lot stronger than anticipated. And it obviously means we won't be going into a recession. And even they say that the good news is that for the next 6 months or so, we are all in agreement that measured inflation will decelerate. So it could well be a 6-month period of Goldilocks. That's to say, strong, reasonable earnings at the same time as inflation coming down. And they say, why is that inflation is going to come down so much in the next 6 months? It's particularly due to the easing in last year's surge in US rental inflation. They're very bullish on the markets for the time being. One of the things they look at, of course, always is corporate credit spreads. And those credit spreads have narrowed significantly over the last month or two, underscoring that the backdrop is conducive to risk on for now. In terms of economic activity, global PMIs confirm that conditions are on the margin firming in certain parts of the world, particularly the Euro area, China and Japan, and yet still on the soft side in the US and the UK. And three significant factors stand out for the improved global economic outlook. The first of all, the fear of policy overshooting has receded as inflation pressures are rolling over. Second of all, China, the COVID zero policy was abruptly stopped in December. We expect steadily improving economic data in the coming months, with some positive contagion throughout Asia and globally. And then third, the economic threat from the energy crisis has ended. Gas prices in Europe are now lower than where they were before the Russians invaded Ukraine in February last year. Couple that with an easing in long-term bond yields is very positive for growth in Europe and also very positive for inflation. Looking now at the Federal Reserve policy outlook, Powell stated in the most recent policy meeting conference he said we have no incentive or desire to over-tighten. And he also said most forecasters would say that unemployment will probably rise a bit from here. But I still think and continue to think there is a path to getting inflation back down to 2% without a really significant economic decline or significant increase in unemployment. So that is positive. I don't think MLB quite subscribe to it. They do think that in the end we'll need a recession in order to beat inflation. So the final word is positive. We recommend a close monitoring of bond market developments at the short and long end and globally. For as long as bond markets are calm, the risk-on phase should have further legs. And of course, encouraging that despite that disappointing inflation reading yesterday, that the bond markets were indeed calm. Their asset allocation, they recommend an overweight position in equities to emerging markets, to China, and also to Europe, and an underweight to the US. They say that caution towards the dominant US market is offset by a more positive outlook for the euro area and emerging market equities. I think it's fortunate that the most recent additions, when we went back to full weighting in equities across portfolios, was to buy in Europe and in China and in the Far East. There are tentative signs that global manufacturing activity is bottoming, which typically is followed by a pickup in economic momentum. The view on bonds, this is the big thing that we need to look out for, the canary in the coal mine. They're saying watch out for bond yields in Europe, because even though they're fairly range-bound for the time being, they're exhibiting a chart pattern of higher lows and higher highs. So it's a step pattern upwards. And also they caution that the yield curve control policy in Japan could end fairly soon with the new governor of the BOJ, Ueda, who was appointed yesterday by the president of Japan, and nobody quite knows whether he's a dove or a hawk, whether he's going to continue, whether with the very dovish policy of his predecessor. So the concern and one of the fears for the global markets this year is that if the Bank of Japan abandons its yield curve control and very dovish central bank policy, that there could be a sharp strengthening in the yen and an unwinding of a lot of yen positions in overseas bond markets, in turn causing some calamity and volatility in world currency markets. Yeah, he says watch out for bond yields generally. For the time being in the US, they're well behaved, but the anchors for global bond yields, Europe and Japan, look like they might unravel. Let's move on now, more cheerful stuff. Europe and China, very bullish outlooks. We begin now with capital economics. Capital economics say that surveys since the start of this year suggest that the Eurozone might now be performing better than the US in absolute terms. Composite PMIs are now at a higher level in the Eurozone than the US, reflecting developments in both manufacturing and services. So 4 things contributing to that positive outlook for Europe. First of all, the slump in natural gas prices. Second, significant government support in the form of energy price caps and direct transfers. Third, the speed with which supply shortages have eased. And fourth, the impact of rising interest rates. So in the US, interest rates have increased by 4 percentage points already in the current monetary tightening cycle, whereas the Eurozone rate only 2.5 percentage points. So the region may even avoid a recession, and this is capital economics speaking, whereas before they were quite sure that Eurozone GDP was going to drop by around 1.5%. So even if there is a recession, they capitulate that it may be milder than we had feared. So very good news for Europe, also very good news for China. Capital economics, again, some of the moves in China's financial markets that followed its rapid reopening have unwound in the past couple of weeks, but we think they will soon resume. They don't see any evidence of excessive exuberance in China's equity markets. Earnings are still a very long way below their peak levels. The positive view is reiterated and mirrored by MRB. They say, again, stay overweight in emerging markets. The travel boom during the Lunar New Year took place in the middle of a reopening and a rapid spread of COVID infections. It was a remarkable outcome, and they now look forward to the next stage, revenge consumption, financed by excess savings hoarded during the lockdowns. Improving earnings momentum, which stand in sharp contrast to softening earnings momentum in the US. So economic conditions are also stirring. Our global economic momentum indicator has been steadily improving since mid-2022. So good news on liquidity. Liquidity drives markets. Tax incentives for rooftop solar is good news. By some estimates, households are already adding 1,000 megawatts of solar power per year in South Africa, combined with a planned feed-in tariff already being pursued in the city of Cape Town, will make a meaningful impact on reducing load shedding over the medium to longer term. Gielie, that's all from my side. Over to you on the local markets.
Hi, Nick, thank you very much. Locally, not much has been happening. First, the bad news at Anglo American Platinum. We hold a few shares there. They expect to report a decline in HEPS, headline earnings per share for the year to December, of between 33 and 50%. That's a big one. The results are due out on Monday. Anglo American, we also own Anglo American. They own 80% of Amplats. Amplats and Anglo American has announced that Natasha Viljoen, she's the CEO of Amplats. She's resigned and she will join an American company. She will be CEO of the Newmont Corporation in America within 12 months. She's got a notice period of 12 months to serve out. Better news is that Anglo American, they agreed to buy a 10% minority interest in a Canadian nickel company. Canada is rich with nickel, and they bought a 10% share there, and that is just to get into the battery minerals. Bad news again from Italtile. In a recent trading statement, management guided for the headline earnings per share, the HEPS, to decrease between 77 and 79%. It's a big drop. Luckily, it's not the fault of Italtile itself. It's just the environment that's been very negative, and they're struggling at the moment. They reported a dividend. Let me see, the dividend was up 6% to 32 cents, and the net cash on the balance sheet was up 51% to nearly R1 billion. So the company is still strong. There's nothing wrong within the company. The problems are outside the company. And then Dischem, as per the Bloomberg consensus, the adjusted earnings per share and revenue over the second half of the year increased with 23% and 14% respectively. That's not bad. That's positive. Then British American Tobacco, we don't own it, but we own Reinet, who has got a big holding in British American Tobacco. Their earnings per share for the year is a slight decline of 1.3%. And just something else which is interesting, we don't own Spur Corporation, but their headline earnings per share for the 6 months to December will be up 200%. It just shows you that the hospitality companies and the restaurants are not doing bad at the moment. They're doing very well.